Welcome to the Ring of Knowledge, your trusted source of financial and practical knowledge. Should you invest your money in Google? Alphabet, the parent company of Google, has become one of the most successful and profitable companies in the world, with a market capitalization of over $1.2 trillion. Google dominates the online search and advertising service and has diversified into other areas such as cloud storage, mobile operating systems, and more. If you're considering investing and you're wondering whether you should invest your money in Google, then you've come to the right place. Stay tuned as we present you with 10 reasons to buy Alphabet stock. In this video, we will take a closer look at Alphabet's competitive advantages, stock structure, performance metrics, recent news, and future growth prospects that will help you make a better judgment for answering your question. Who is Google? Alphabet, formerly known as Google, is a vast technology conglomerate that oversees various businesses in the digital world. Its portfolio includes the world's most extensive internet search and advertising service, YouTube, the renowned mobile operating system, Android, cloud storage services, and numerous other growth-oriented ventures. The company's name has become synonymous with online search engines and the internet, to the point where the verb to Google means to look something up on the web. Operating out of California, Alphabet processes billions of search requests each day, making it one of the most conspicuous and identifiable private organizations globally. While the firm is invested in a vast range of internet-based fields, including email, social media, video, analytics, robotics, and many other areas, its primary source of revenue and earnings comes from internet search. Google has proven to be one of the most profitable stocks of the 21st century, having started at just over $50 per share in August 2004 and reaching a value of $1,125 per share in 2019. Despite not paying dividends, investors from all walks of life have flocked to Google, transforming it into a $660 billion behemoth. If you're considering investing in Google, what information should investors have before determining whether to invest in Google? The competitive advantages that secure Alphabet's future. The world of investing can be a tricky place, and finding a company with a competitive advantage is crucial for safe investments. One crucial indicator of a secure company is its moat. A moat refers to a competitive advantage that makes it difficult for other companies to challenge that business. For instance, cable companies have a moat because of the high cost of building new wiring infrastructure. Another example is Coca-Cola, which has an iconic name among consumers. In the same vein, Google has a moat in the world of the internet. Google's moat is particularly noteworthy given the rapid pace of change and intense competition on the web, which has a flat structure, making it easy for anyone to build a competitive service. Despite the competition, Google has been able to gain and maintain its dominance by delivering better results at faster speeds than its competitors. This competitive advantage is what has enabled Google to stay ahead of the game. What's more, Google has been able to consolidate its market share by leveraging its Chrome browser and Android operating system. These tools give Google access to a vast pool of user data, which they can use to personalize their services and stay ahead of the curve. Additionally, Google pays Apple to be the default search engine on Apple mobile devices, which helps it maintain its dominant position in the search engine market. In short, Alphabet's competitive advantages make it a safe investment for those looking to invest in the tech industry. The company's moat, in particular, sets it apart from its competitors and ensures that it will continue to thrive in the ever-changing world of the internet. Understanding Google's stock structure, an overview for investors. Google, the technology behemoth, has long been known as one of the most innovative and dynamic companies in the world. However, what is often less known is the intricate structure of its stock. Google operates with two different types of shares, A and C, which are listed on the Nasdaq Stock Exchange. The A shares of Google, trading under the ticker symbol Google, G-O-O-G-L, carry one vote per share and are the best option for investors looking to exercise their voting rights. The C shares, traded under the ticker symbol G-O-O-G, do not have any voting rights. Interestingly, the founders of Google, the company chair, and a few other directors own the firm's B shares, which are not publicly traded, and they carry 10 votes per share, giving them the majority of voting power. In 2014, Google split its stock into A and C shares, which increased the number of outstanding shares and cut the price in half. This change in stock structure ensured that Google's founders would maintain their control over the company even as they sold large numbers of shares to investors. The price of Google's A shares is generally at a small premium compared to its C shares, reflecting the fact that the market does place some value on voting power. In summary, while investing in Google can offer potential financial gains, investors must be aware of the differences between A and C shares and the voting power they carry before making any investment decisions. If investors wish to vote at stockholder meetings, they should consider investing in the A shares of Google. Alphabet's performance metrics. Alphabet is an American multinational conglomerate that has become synonymous with online search engines and the internet. The company oversees several businesses, including the world's largest internet search and advertising service, the popular streaming video website YouTube, the Android mobile operating system, cloud storage services, and varied other growth ventures. As an investor, one may wonder how Alphabet compares to other technology companies and whether investing in the company is worth it. A good starting point is to examine Alphabet's market capitalization, which refers to the company's total market value, calculated by multiplying the total number of outstanding shares by the price per share. At $1.248 trillion, Alphabet is among the most prominent companies globally, trailing only Apple, Saudi Aramco, and Microsoft in terms of market cap. While a high market cap does not guarantee that the company will be successful in the future, it is a positive sign of success in the long term, especially for well-established companies that understand their market and customers. Another way to evaluate the value of a company's stock is through the price-to-earnings, or PE ratio. The PE ratio compares the current market price of a company's stock to its earnings per shares, or EPS, and provides insight into whether the stock is a good value at its current purchase price. A lower PE ratio is better, as it indicates that the stock is a better value relative to its earnings. Alphabet's PE ratio is 18.45, which is a favorable ratio when compared to other technology companies such as Apple, Tesla, and Amazon. In contrast, Apple has a PE ratio of 25.10, Tesla's ratio is 69.37, and Amazon's is a whopping 99.46. Thus, Alphabet's PE ratio indicates that its stock is more favorably valued relative to its earnings than the other behemoth tech companies. 10 reasons to buy Alphabet stock. Number 1. Google's search monopoly. Google's dominance in the search industry has made it an unstoppable force. While most monopolies are forbidden by antitrust laws, Alphabet, the parent company of Google, has found a way around it. Google has created a natural monopoly by improving its search engine's quality through increased usage, making it hard for competitors to break into the market. The search industry's inherent nature does not lend itself to competition, which means Google's position as the search leader will be challenging to unseat. With more than 90% of the search market share worldwide, Google has achieved immense market power, colossal profits, and a formidable presence in the tech industry. The likelihood of a competitor rising to the challenge and toppling Google's dominance is slim to none. Number 2. Alphabet's exceptional operating margins. Alphabet's operating margins have been steady in the range of 25% to 35% over time, but this range belies the impressive profitability of Google's core search business. Google Services, which encompasses advertising, hardware, YouTube subscriptions, and Google Play, reported a 32% operating margin in its latest quarter, surpassing the overall company's margin of 25%. Although Alphabet doesn't disclose the operating profits of individual businesses like Search, it is highly probable that Search's margins are even more substantial than Google Services. In essence, Google's proficiency in its core business activities is a significant factor in Alphabet's impressive operating margins. Number 3. Google Cloud's promising growth. Google Cloud, Alphabet's cloud infrastructure business, may lag behind industry heavyweights like Microsoft Azure and Amazon Web Services, but it's growing fast. In its most recent quarter, revenue surged by 38% to $6.9 billion. Although it's currently unprofitable, this should change over time. Google Cloud's operating margin improved from -14% to -10% in Q3, and the management has a clear roadmap to achieving long-term profitability for the segment. Although it may not be able to match the profitability of its larger rivals, Google Cloud has the potential to become a significant contributor to Alphabet's bottom line. With a focus on innovation and improvements in its operations, Google Cloud is poised to become a major player in the cloud infrastructure industry. Number 4. Alphabet's stock struggles amidst slowing ad market. Alphabet's stock has been on a downward trend due to the current state of the ad market, which is experiencing a slowdown as businesses brace themselves for a potential recession. In the third quarter, Alphabet's revenue only grew by 6%. However, this isn't the first time that Alphabet has faced such a situation. The advertising industry is known for being cyclical, and Alphabet experienced similar trends during the 2008 and 2009 financial crisis and when the pandemic began. Number 5. The future potential of Alphabet's Other Bets division. Alphabet's Other Bets division, which includes moonshot projects like Waymo, the autonomous vehicle AV division, has cost the company over $20 billion in the last 5 years, with little revenue to show for it. But that can all change in the future. The potential breakthrough of AV technology would be a game changer and likely revolutionize the industry. Number 6. Alphabet plans to rein in costs. Alphabet has been criticized for investing heavily in its Other Bets division without producing significant revenue. However, the company is taking steps to reduce costs, including slowing down hiring in the coming months. It's unclear whether the same measures will apply to Other Bets, but the cost-cutting efforts are a positive sign for investors. While Alphabet has not announced any large-scale layoffs, unlike other major tech companies, it remains a possibility as CEO Sundar Pichai has expressed concerns about productivity. Number 7. Alphabet's aggressive stock buybacks to boost earnings per share. Alphabet has traditionally been a money-making machine, but lately it has been focusing on returning some of that cash to investors instead of just hoarding it or investing in projects like Other Bets. In the past year, the company has bought back 433 million shares, spending $43.9 billion on stock buybacks over the last 9 months. As a result, its share count has reduced by 3.2%. With the current stock price down and $116 billion in cash and equivalents, Alphabet is likely to continue to buy back shares aggressively, which will have a positive impact on earnings per share. Number 8. Alphabet's stock valuation. Alphabet stock is currently trading at a price-to-earnings ratio of 19.5 on a trailing basis, which is lower than the S&P 500's ratio of 20.5. This suggests that the market believes that Alphabet's earning growth will be slower than the broader market. However, this seems like an underestimation, given the company's strong history, dominant position in the search market, and active share buyback program. While a potential recession may cause temporary setbacks, the company's future growth prospects remain strong over the long term. Number 9. YouTube emerges as a strong competitor in streaming wars. While YouTube has historically not been seen as a major player in the streaming wars, that perception is changing. With no real competition on the free side, the video sharing platform is leveraging its massive and dedicated user base to monetize its offerings. Its paid options, YouTube TV and YouTube Premium, have gained significant traction, with the subscriber count surpassing 80 million, up from 50 million just a year ago. This surge in subscribers now makes YouTube a legitimate contender to the likes of Netflix and Spotify. Number 10. Alphabet's growth. Alphabet has delivered impressive returns to investors since its initial public offering in 2004, returning almost 4,000%. Although the stock has declined significantly in the past year, the company's fundamentals are arguably stronger than ever. Its search engine continues to dominate the market, and the company is benefiting from a shift in ad budgets from social media to search. Additionally, Alphabet has the means to further reward its shareholders through buybacks, and with growth of connected TV, particularly YouTube, the ad market is expected to expand over time. Therefore, despite the stock's recent underperformance, Alphabet's future looks promising.